Hello, traders. It is Matt Stevenson with Paragon Funded Trader. This picture. Have you ever had one of those? This happened to me, um, and I decided to write about it because somebody mentioned the topic of consistency rules. Now, we don't have those, but a lot of firms do. So I wanted to talk about it because I almost really screwed up my account. So, but have you ever had one of those perfect trading days where the market just hands you exactly what you were looking for? Well, a few months ago, I had one of those in a funded prop firm account. I absolutely crushed my profit target, but instead of an email congratulating me on my upcoming payout, I woke up to this message that said a critical warning that my account was under review. I was inches away from losing my funding entirely, and the crazy part, I didn't break any drawdown rules. That's what made me so frustrated. I almost lost it simply because I made too much money too fast. Let me show you exactly what happened. Here's the setup. I was having a solid, steady run in my funded period. Then I caught a massive move and locked in an 8,500 profit, $8,500 profit in a single session. I had practically hit my withdrawal target in one day. But here's the reversal. When I went to request my payout, the system flagged me. My quote crime wasn't poor risk management. It was triggering an automated review because that single day's profit was considered disproportionately large compared to the rest of my trading history. And that's true, but it wasn't my fault. When we look at the diagnostic reality on a chart, it becomes clear. This line represents my account growth. That sharp spike is the $8,500 day. Notice that yellow dotted line. That represents a hidden maximum threshold. By making so much in one sitting, that single day represented too large a share of my total accumulated profits. The moment my equity crossed that invisible line, I instantly violated a clause buried in the funded agreement. The hidden clause is known in the industry as the consistency rule, but it's more than what we consider the consistency rule because this hidden clause meant something more. It boils down to a simple mathematical formula, and this is what we all know. Take your single best trading day profit and divide it by your total accumulated profit. If that resulting percentage, X, is greater than, say, 30 or 40% or whatever their rule is, your account is flagged and your payout is denied. It's a contractual stipulation designed to force you to spread your profits out over multiple days. This is why Paragon Funded Trader does not have consistency rules. This rule, yes, they don't. Okay, let's think of all the reasons why a firm might have this rule. They don't want to reward the lucky. Is that the reason? Why? Why not? It's not going to happen a lot, right? Because it's luck. So I just don't understand it. It's yet another way for them to deny a payout, in my opinion. That's why we don't have them. To understand why this rule exists, we have to look at it from the prop firm's perspective. They don't want to pay out. Statistical luck. Like I said, if a trader just YOLOs a massive position, gets lucky on a news event, and hits their target in one $10,000 day, they haven't proven they can trade. They've proven they can gamble. The prop firm's goal is to fund traders with a repeatable edge. They would much rather see 10 $1,000 days. It proves consistent, methodical risk management and long-term viability. Now, whoever wrote that is very, very good. because that all sounds very good, right? So I'm going to leave it at that, but you heard my version. Once I realized this, I started looking into the fine print of the biggest firms in the space. As you can see, this rule is everywhere almost. Top Step, Apex, Take Profit Trader, they all enforce Alpha Futures, they all enforce a strict 30% consistency rule. Some enforce up to a 50% consistency rule, and some as low as 25%. Effectively capping your single day profits and keeping your trading freedom index very low. Firms like My Funded Futures and Alpha are slightly more forgiving at 40%, but the cap is still there. However, the landscape is changing. There are exceptions if you know where to look. For example, Paragon Funded Trader have completely abolished the consistency rule. We don't care because one of the reasons is we fund you with real capital. If you make a lucky gain, you made the gain. We can pay you out. The gain is there, the money is there. No 30% cap, no 25% cap, no 40% cap, no payout denials for having a massive green day. Issuing a rule against it implies that it's going to happen all the time. When they just said it was luck. Luck doesn't happen all the time. And luck can happen the other way as well. So, I still prefer my version. If you are a trader prone to catching heavy outlier moves, you need to be trading in a 100% rule-free environment for pure performance rather than fighting the math at the more restrictive firms. Okay? So if you find yourself occasionally having massive moves, come trade with us. I mean, absolutely. Just for that reason alone, because you will not be uh, punished for it. In fact, it won't affect anything but help you. But what if you are already funded with a firm that enforces the consistency rule, like I was? You need a strategy. The objective here is not to avoid massive green days. We always want to maximize our winners, right? The objective is to ensure that no single session mathematically appears as an outlier by the time you request a payout. So if you do get those outlier moves, just kind of try to throw in a few more. So, at least there's a gray area. So it looks like it's not just one big massive thing that won't ever happen again. Doing this requires active intra-month lot size manipulation. And this is where it gets too complicated. Here's the exact playbook, though, to save your account if you accidentally trigger this rule. Let's say the event happens, you have a massive green day, and realize it makes up over 30% of your total target, okay? Action 1, size down immediately. Cut your standard lot size by at least 50%. Action 2, bank conservatively. Stop trying to hit home runs and trade exclusively for high probability base hits over the next few days. The result? Mathematical dilution. As you pad your total accumulated profit with smaller wins, the percentage share of that massive outlier day naturally drops below the threshold, safely unlocking your payout. So that's how you can do it to semi-disguise it and dilute it. Here's what that dilution tactic looks like in practice. Look at the yellow line. Curve A. That's what happens if you keep trading normal size after a massive day 4 spike. You inevitably hit that red flagged threshold. Now look at the blue line, curve B. This is the engineered equity curve. By aggressively sizing down right after that day 4 spike, we flatten out the trajectory. We take base hits, slowly grinding our way up to the green payout target line by day 20. We dilute the outlier day, safely trigger the payout, and avoid the review entirely. All right. If you have any questions about this, contact us. We'll be happy to walk you through it live. But having to do this brings us to a harsh reality, the prop trader's dilemma. On the left side, we have your primary job, maximizing your trading edge, letting winners run, and capitalizing on big outlier setups. On the right side, we have the firm's constraints, artificial profit caps, forced lot size reductions, and consistency pacing. When you force a limitless trading strategy into a mathematically capped environment, you end up compromising your edge. And they know this. You spend more time managing firms' rules than actually trading the markets. It's getting to be that way, and it's frustrating to watch. Ultimately, you have a choice. You can continuously engineer your equity curve and play defense to survive restrictive firms, or you can trade in an environment built for outperformance. You have to protect your edge. If your strategy relies on capturing massive market moves, do not partner with a firm that penalizes you for doing your job well. Choose an environment that actually matches your execution style. At Paragon Funded Trader, we have partnered with Prop Account and FPFX Tech. Do your research, do your due diligence. We don't have a long history, but they do. They have a 100% payout track record. And it's because the way that we fund traders. At Paragon Funded Trader, we've removed the friction. No consistency rules, no artificial caps, just trading. We are on your side. All right, guys, we'll see you next time.